The energy sector. We've seen lots of talks about this on X, and we've had lots of talks in the Summit community about this. Right now, energy is quietly becoming one of the most important macro pressure points again. This isn't because oil is suddenly exciting, but because demand is becoming structural while supply is low, constrained, and politically boxed in. At Summit, we're not fully in yet, but we're watching the energy sector very closely. And today I want to walk you through why using the data that's actually starting to line up. Now, if we start with power demand, the International Energy Agency projects global data center electricity consumption more than doubling to around 945 terawatt hours by 2030, driven largely by AI and compute. As you can see here, this isn't marginal change. It's a meaningfully new source demand layer on an already tight system. And the key point is timing. This demand is being pulled forward while supply infrastructure still takes years to build. That imbalance is where energy starts to matter again for markets. Now, it might sound boring, but it's very important. If we look over to the supply side, even after years of higher prices, upstream investment remains restrained. The IEA's latest outlook shows global upstream oil investment up around $420 billion, still well above what you'd expect for a rapid supply response. That's discipline, regulation, ESG pressure, and a long project timelines all showing up in one place. So when demand surprises even slightly, prices don't need to explode. Supply can't just flood the market quickly anymore, and that's a very different setup than the past cycles. You can actually see the bottleneck forming right now. A CleanView breakout shows roughly 75% of planned on-site power for new data centers is leaning towards natural gas. Not because it's perfect, but because it's fast, reliable, and available and good connections are delayed. That tells you something important. Reliability is winning over ideology. Energy isn't just a commodity trade here, it's becoming a system constraint. Now I want to bring this over to markets. XLE, the Energy Select Sector ETF. It's our base layer watch at Summit. As you can see here, XLE has had a major breakout on the 1-month chart, and it's had its highest weekly close ever. You can also see here that XLE has recently pushed into the top of its 52-week range. This matters because capitals are starting to rotate into the sector, not aggressively but deliberately. XLE is dominated by large integrated energy companies, the ones that's built to survive volatility, generate free cash flow, and return capital through dividends and buybacks. So if energy stays supported even without a spike, this is the part of the sector which can still work. The more interesting layer here is uranium. Uranium is a fuel input for nuclear power. And nuclear is back in focus because it provides reliable baseload electricity at scale. With AI data centers and electrification all pulling demand forward, baseload stops being optional. As you can see here, uranium pricing benchmarks remain elevated, reflecting how tight this market is relative to long-term demand expectations. This isn't about hype, it's about physics and supply chains. And now we have the non-obvious one, State Street. State Street isn't an energy company, it's financial plumbing. It sits behind ETFs, custody, and asset servicing. So why does this matter? Because if capital starts reallocating into energy, whether that's oil, gas, uranium, infrastructure, most investors don't buy wells or reactors, they buy funds. State Street benefits when assets move through the system regardless of which sector is in favor, so it's an indirect way to express capital rotation, not commodity pricing. Now the important part and why we're watching and not chasing is that energy performs best when financial conditions aren't actively tightening. We want confirmation that liquidity isn't being pulled away aggressively, and if this backdrop stabilizes, energy is one of the cleanest setups right now. It has real demand, constrained supply, strategic importance, and improving cash confirmation. So this is why energy is back on our radar. XLE gives us disciplined cash flow exposure, uranium captures baseload scarcity, State Street reflects capital moving into the theme, and we're not fully positioned yet, but this is one of the cleanest areas where macro real-world constraints and macro structure are starting to align. And that's the exact kind of setup we want to be watching early and not chasing late. So if you want to see our entries, if you want to talk to us more about macro environments and all different types of markets, I'll leave a link to the free Discord down below. I'll also leave a link to our website down below where you can join the weekly watch list. We do weekly setups, we watch levels, and we give macro context every single Sunday. And one of our most important tools at Summit is the Summit Indicator. You can also get access for this, and this makes it super easy for everyone. You don't have to draw lines on charts, you can just see bull trends and bear trends on the Summit cloud. Make investing as easy as you can for yourself, check it out, and if you did like the video, please leave a like and subscribe.